Good morning, everyone. Thank you for joining us here at Duncan and Soplis for our webinar, Preparing for Changes, FRS 102 Revisions. I'm Stuart Brown, the Head of Technical and Compliance here at Duncan and Soplis, and I'm joined today by Will Cousins, the Technical and Compliance Manager. There's quite a lot to get through today. These revisions are significant and can really have a significant impact on you and your business in terms of your financial reporting. So the main thing I'd like you to take away is an awareness of the changes and to know that something could impact you and seek advice from ourselves if needed for our support. Hopefully with 45 minutes, hopefully we'll have some time for questions at the end. As mentioned, it's quite a lot to get through. But of course, we will be available following the webinar for any follow-up questions. So I'll start by looking at revenue. So this is one of the big areas. There's two main areas of the changes, but there are a number of others as well, which are all important still. So I'll start with revenue. I'll look at the background, introduce this 5-step model approach to revenue recognition. We'll look at the transition from the current FRS 102 to the revised FRS 102, and also provide an example of the transition. Will then run through leases, the changes. Again, these are very significant changes to lease accounting, especially impacting what we currently classify as operating leases. He'll run through some background and the impacts of this. I look at the changes to the accounting treatment. I look again at the transition approach, which actually differs from revenue quite significantly, and provide an example. Then go on to look at some of the other changes. As mentioned, some of these are quite minor, but some are quite significant, especially changes relating to the smaller entities. There's also a change relating to the cash flow statements for those who have a cash flow, who need to prepare a cash flow statement, which actually come in a year in advance of all the other changes. A bit strange, I don't know why, but that's the case. So revenue. The changes, as with the vast majority of these revisions, come into play for periods beginning on or after the 1st of January 2026. Now you can early adopt the changes, but all revisions need to be early adopted. So it's quite a big undertaking if you do plan on, say, for your 2025 year end, using the revised FRS 102. Motivation behind this is to more closely align to international reporting standards, specifically IFRS 15. Now, the big message here is that this could have a very significant impact on your business. If you have lots of different contracts with customers, especially with variable terms, bespoke terms per customer, then it can have a big impact on you. For others, it might not have any impact. If you buy something and sell it at a set price and there's one item, then this revenue section probably won't impact you very much at all. The revised section does relate to, relate to all contracts with customers other than those areas covered by other areas of FRS 102. So, for example, leases, insurance contracts, some financial instruments and non-monetary exchanges like barter exchanges, which are very rare, but just for completeness, we've included that. So the 5-step process, this is a move away from recognizing revenue as it currently is, which is when the risks and reward of ownership are exchanged. You now move to this, this mirrors the IFRS standard, which is a 5-step model. So step 1, identify the contract. 2, identify what you need to do to provide to your customer the performance obligations. 3, determine the transaction price. 4, allocate the price to the performance obligations. And 5, recognize the income. Again, this can be very simple. You might buy something and sell it over a shop counter, for example. The contract is to provide whatever you're selling. The price is what the price is. There's only one obligation, so that's the price, and you recognize it. Alternatively, you could have a very complex contract. Well, each of these items need to be considered in a lot more depth. So there's a lot of detail here straight from the standard. I won't go into this in detail, but the first step is to identify the contract, make sure there really is a contract in place between you and your customer. Has to be commercial substance, has payment terms in there, and it needs to be probable that the customer will have the ability and actually the intention to pay, which hopefully will be the case for making a sale to a customer. Step 2 is to identify the performance obligations within the contract. So this is the promise to transfer goods or services to a customer. Again, this can be very simple. Many contracts will only have one obligation. However, there may be various obligations within the same contract, and it's not always straightforward. An example here would be a mobile phone contract where you buy a phone and you get the handset included in the deal. Well, there's two obligations there from the phone provider company, and one to provide you with the handset, and two to provide you with the use of that mobile phone. And they're separate obligations within the same contract. 3, determine the transaction price. Again, this could be simple, but some contracts include complex factors. For example, variable consideration. X has to happen for Y consideration to be received. And there's some very specific terms there about how you recognize that variable consideration now. For example, it needs to be classified as highly probable, which the FRS 102 helpfully defines as more likely than probable, which of course is very much open to interpretation. So you've got the contract, you know what the obligations are, you know what price it is. The next step is to allocate the overall price to those individual obligations then. Again, I keep reiterating this, it can be simple, but it can be very complex. It's a very wide scope here. An example of this would be a contract where there are 3 embedded obligations, and they each could be provided to the customer at individual prices of £17,000 in total. However, the combined cost of this has a discount embedded in it because the total would be £15,000. What you need to do in that case is to allocate that discount evenly over the 3 obligations. It's a very high level example of what this means. And step 5, you then recognize the transaction price as your income as the obligations are met. How this happens very much depends on the details of the contract. And the obligations are met by satisfying those performance obligations, so transferring the goods or providing the service to the customer. For example here, a construction contract, as is currently known, that term does disappear as FRS 102 is revised, will still be recognised over the life of the contract at certain times, depending on the contract details, not all at the beginning, not all at the end, when the construction is completed. Unless, again, it specifically does state that in the contract. So it transfers these goods or services over time of these. I won't go through each step in detail. There's some detail there from FRS 102. But as point A is referring to something like a service contract where you provide over time the same support or service and you recognize the income as that's provided, or you get to a certain point in the contract, such as a milestone recognition. So that's the 5-step process. So now moving on to the transition. Now for revenue, it's a transition from the current FRS 102 to the revised FRS 102. There is a choice of approaches here, which differs from other areas. So you can take a full retrospective approach where you fully restate the comparative information, or the cumulative catch-up approach, which is where you just make an adjustment to the reserve position of the current year. So your prior year, your comparatives under cumulative catch-up are not touched at all, which in theory doesn't make them comparative, but that's allowed by the transition approach. And what's best for you or your firm really depends, again, on what impact the change to FRS 102 will have on you. So we've got a transition example here. So entity Z has entered into a contract under the current FRS 102, so the 1st of September this year, and this had a total transaction price consideration of £60,000. Now this is split into two separate obligations. So you have a software license, which is delivered immediately. Here's your license, it's done. Obligation is met, and that's worth £45,000. Linked to this is technical support over the 12 months. And this has been allocated £15,000, which is recognised over the life of the contract, over that obligation. So in this example, the entity has a year end of December and is transitioned at the beginning of the 1st of January 2026. Well, a simple example. So the transition date in this instance is the same as the date of the effective date of the revised financial reporting standard. So currently, in most cases, it's not always the case, but most cases you could recognise the £60,000 immediately in full in September, because you would say that all risks and rewards of ownership have been transferred. So upon transition of the revised FRS 102, you can take two approaches. So we'll just quickly run through both of those different approaches in this example. So first of all is cumulative catch-up. So important point here is that the comparatives are not restated. We don't touch the prior year. We wouldn't touch the 2025 accounts at all. But instead, there being an adjustment to the opening return date, so retained earnings at the transition date, which is the cumulative difference of all the contracts would be made at that date. So the existing position in this example was that the full £60,000 had already been recognised. However, under the 5-step process, the performance obligation for the provision of that technical support, the £15,000 element, needs to be recognised over 12 months. So to the end of 2025, we should have only recognised 4 months of that element. So just to reiterate that, £45,000 recognised in 2025, absolutely fine, no problem with that, under the revised standard as well. But support, we do only need to recognise £5,000, which is a third of the £15,000 we had previously recognised. Overall, that means we have over-recognised, we've overstated revenue in 2025 by £10,000. So under the cumulative catch-up approach, it's quite a simple journal, but getting to this point is the difficult bit if you've got complex contracts, is that we would adjust in 2026, not 2025 again. We would debit retained earnings, we'd reduce retained earnings, and we defer that £10,000 income until the obligations are met through the 8 months remaining on the contract in 2026. For retrospective, it's the same adjustment. We've got the same £10,000 of overstatement at the end of 2025, but we don't adjust it in 2026 now, we adjust it in 2025. So the prior year adjustment then, therefore on the transition, where we would reduce revenue itself reported in that year, and also still, though, introduce that liability balance, deferred income. So as a summary, cumulative catch-up, do we adjust in comparatives? No. Full retrospective, yes. Adjustment type, we would touch the retained earnings. In the current year, cumulative catch-up, for retrospective, we would touch, adjust the revenue stated. Adjustment date, date of transition for cumulative, for retrospective, again back in the prior year, but we end up with the same contract liability, deferred income, at the 1st of January 2026. So this is a very simplistic example. This could get far more complicated if you're looking at things like variable consideration, probability of future income, probability of future outcomes of a contract. Yes, there is a number of complex areas here. The underlying message here is if you do have contracts and they are complex, or you have a number of contracts for different customers with variable items, bespoke elements, then it's something you really should be thinking about now at this stage. Thank you. Now I'll pass over to Will Cousins to run through the changes to lease accounting.
Thank you, Stuart. So, as Stuart mentioned, the two what we perceive as being the main changes to FRS 102 are revenue, as Stuart's just discussed, but then also leases. So I'm not going to go over this in too much detail because Stuart's already covered a lot of this. But again, as with the case with revenue, the mandatory changes take effect for periods beginning on or after the 1st of January 2026. But you can early adopt, but you have to early adopt all the standards if you're going to do so. The other key points to note here are that this isn't applicable to micro entities preparing their accounts under FRS 105. And I suppose the other point that we need to note is essentially that the difference is that operating leases will now be recognised on the balance sheet, as is the case with finance leases. Thank you, Stuart. So, firstly, what is a lease? Again, FRS 102 defines a lease as a contract or part of a contract that conveys the right to use an asset, the underlying asset, for a period of time in exchange for consideration. The key point to note here is that for an agreement to constitute a lease, there must be an underlying asset. There are a couple of exemptions to recognising operating leases on the balance sheet. The first one being short-term leases. This is a lease that at the commencement date has a lease term of 12 months or less. The important thing here is that the overall term of the lease is 12 months. So if you've got a lease that at the 1st of January 2026 has less than 12 months left, if that lease was initially more than 12 months, we would have to account for all the lease that has passed on transition, and we would still need to capitalise the remaining life of that lease. It's only if the overall lease is less than 12 months that it's exempt. The other exemption is low value assets. IFRS 16 gives a value, but FRS 102 does not put a monetary value on low value assets. There is a list of asset types that cannot be considered low value, such as cars, vans, boats, production line equipment, vehicles. So this would be more aimed at sort of low value contracts for phones, for example, potentially. So in terms of the impact, and we'll go on more to how it's going to impact companies as I go through these slides, but in essence, it's going to impact any business that has operating leases. And it sounds obvious, but the greater the quantity and value of the leases, the greater the impact. It's also important to note that this does also include rented property. And I think the key point to reiterate today is we need to start thinking about this now, because it is going to impact lending, covenants, and various other parameters, which I'll go into. And also to note that there's very little change at all to the treatment of finance leases at this stage. So in terms of the impact on the balance sheet, as I've mentioned, we're now recognising a right of use asset for the underlying asset, and corresponding to that is a lease liability for these leases. And this is obviously, it's going to impact your profit and loss, because we're going from recognising a straight line expense to recognising depreciation and interest. This in turn affects EBITDA, which is obviously earnings before interest, tax, depreciation and amortisation. So obviously the EBITDA is going to increase because we're losing that straight line expense above the line, as it were, and now we're recognising interest and dividends below the line. So the bottom line there's a minimal impact, which we'll go on to, but it is going to impact EBITDA substantially, potentially. Then obviously asset turnover is going to change because you've got an increase in asset, and your gearing ratio is unfortunately going to worsen because of the corresponding liability that goes with that. So I think at this point, the important thing to note today is that we need to make sure that you've got the infrastructure in place to account for the changes correctly, but also that you're communicating with your stakeholders, investors, lenders, and any analysts to kind of reiterate the changes that I've noted and how that's going to impact, especially sort of covenants on loans. So in terms of the changes to the accounting treatment, as I've touched on, we're now going to, where previously you'd have an operating lease that's recognised in the profit and loss on a straight line basis, we would now need to recognise a right of use asset for the underlying asset. And we're going to need to recognise a corresponding lease liability. And the lease liability is recorded at the net present value of the remaining lease payments, and that needs to be discounted. And that would be discounted using either the incremental borrowing rate or the obtainable borrowing rate. An incremental borrowing rate is the rate that you could borrow money on equivalent terms over the equivalent life, whereas the obtainable borrowing rate is just simply the equivalent interest rate at which you could borrow the same amount of money. The thing for me to note here for you today is that unfortunately, we can't advise or give you the interest rate to be used. That's something that you will unfortunately have to sort of research and advise us on. So that's the important thing for that. So in terms of transition, as Stuart mentioned, it is substantially different to revenue. And the difference is that with the leases, there is no choice on how to account for the transition. They must be accounted for on the cumulative catch-up method, which Stuart touched on with the revenue, but that means there is no prior year adjustments. We would not be adjusting the comparatives at all. The cumulative impact of the change of initially recognising the assets and leases would all be recognised through the opening balance of retained earnings in the year that the change takes effect. So again, as was the case with revenue, we've got an example to quickly run through here for you. So in our example, Company X has signed a 5-year lease on the 29th of December 2024 to lease a warehouse facility and offices. The lease rentals are 137,500 per annum, and they're paid monthly. So previously, this met the operating lease criteria under FRS 102. But as you'll see, we've got the access to the warehouse and offices, which would form our underlying assets. So this would then need to be accounted for under the new standards with the right of use asset and the liability, which we'll go into. So for the sake of our example, we're using a rate of 7% for our interest, which will become apparent as we run through. So in terms of our lease payments, as I say, it'd be a 5-year lease, 137,500 per annum, which gives 687,500 throughout the lease life, which is 11,458 a month, which will make sense as I go through the example. So the important thing to note here is that for the year ended 31st of March 2025, where we'd have 3 months of this lease if it was signed December 24, and for the year ended March 26, these would both be accounted for under the current standards, because obviously the March 26 year end has started in April 25, which is prior to January 2026. So it'd be the March 27 year where the change would take effect. So just an illustration of what's unpaid. So we've started with the 687,500. So we've had the 3 months to March 25, and then we've obviously each year thereafter we've paid the 137,500 right up to the period to December 29, where we've only got the 9 months because we've had the 3 months in the March 25 year. So with respect to the change, as we say, the lease liability would be recognised at the present value of future lease payments. So in terms of our example, as of the date that the change has taken effect, which in this case is the year which starts on the 1st of April 26, ends March 27, we can see from the lease payments to date that we would have 515,625 outstanding, but we would need to make sure that we discount this. And as I said, in our example, we use 7%. So down below, you'll see this is our net present value calculation using the 7%. And I have checked the maths, it does add up. This gives us, at the date of transition, present value of committed lease payments of 445,025, which will form our lease liability. So at the same date, we recognise a right of use asset, which is the equivalent of the net present value of the lease liability. In our example, we've not put any prepaid or accrued lease payments, but obviously we would need to account for any if there were any. So on the initial date of the application, we've recognised a fixed asset of 445,025 as calculated and a corresponding lease liability. In this case, we may well have, when we started the year, force of habit, we may have recognised our lease liability in the profit and loss, as we would have done previously. If this is the case, we would need to then take this out. We would need to add it to our lease liability, and we need to credit the profit and loss for this. And this just shows a visualisation of what that adjustment would look like. So then the subsequent measurement of the right to use asset, we would need to depreciate that. And under the new standard, the sort of generally given principle would be to depreciate the underlying asset over the remaining useful life, or the remaining life of the lease. So in this case, we'd in essence, we'd be recognising the 445,025 over the 4 years that remain on the lease. So again, we would then need to subsequently remeasure the lease liability, factoring the interest at our given rate of 7%. So as visualised in the table, we've got our opening balance of 445,025. We know that each year we are paying 137,500. However, we've got to then discount the repayments, which then gives us a finance charge to recognise, which is calculated in this table. The calculations, if you've got a calculator in front of you, they might not match exactly for the interest. That's because it's all been sort of portioned over the year rather than recognised at the year end. But again, we've checked the maths and they do add up. So in the March 27 year end, we would need to recognise the interest for that year, and we would for all subsequent years thereafter. And the way we recognise this is as an interest charge on the lease liability. So as you would have seen in the previous table, we've reduced the lease liability by the net cash flow of 137,500, but then by discounting it, we've then had to re-increase the liability by the finance cost, with the corresponding entry recognised in the profit and loss as a finance cost. So just to visualise the impact, as I mentioned when I was going over the overall impact, is there is some profit and loss impact, but it is relatively minor. So in the case given, at the end of March 2027, we're left with fixed assets totaling 333,769, which is the initial 445 net present value less the depreciation charge for the year. We've got a current liability of 115,893. That's the net present value that's likely to be paid in the 28 year end, which is the net cash flows less the interest charge for 2028. And then we've got the corresponding amount in the non-current liability for the periods 28 and 29, i.e. the periods that fall after the next financial year. And the net impact of this is that there is going to be an impact of 2,363 on the profit and loss. So just to surmise that and break down the figures on the previous slide, our profit and loss impact, we've got a reduction in profit of 2,363, which is the gain of not paying the lease rental expense that we would have previously paid. but then that is offset with the depreciation charge and the finance cost, which previously, as I mentioned, the lease rental would be above the line on the EBITDA, whereas the depreciation and finance cost are potentially below the line, which is we need to think about. And then in terms of the impact on the balance sheet, we've still got the reduction in cash. We are still paying the net lease liabilities over. We've also got the right of use asset, which we mentioned is the present value brought forward less the depreciation charge for the year. And then we've got the net present value of the lease liability at the period end, with that difference being the movement in the profit and loss. So that's it for me on leases. I appreciate that is a lot to take in, but hopefully as you start to put this in practice, it will make a bit more sense. And as Stuart said, and as I reiterate, if you do have any sort of questions or any complicated or unusual leases, then don't be afraid to reach out to your Duncan and Topless contact. And we are also available to provide specialist support for the transition and onwards if need be. Thank you, Stuart.
Thank you, Will. Okay, so the final third of this webinar is to look at the other changes. And as mentioned before, there are quite a lot of them, and they're often overlooked. So you've got these big headline changes, leases probably up there at the top, depending on your complexity of contracts, revenues up there as well. But there are a number of other changes that need to be considered. Excuse me. So starting with smaller entities, so those currently using FRS 102 section 1A. So as it stands, there are a number of optional disclosures. They are all going to be made mandatory, including a good example is one related to going concern, which is I'll reiterate in a minute. The biggest one, though, for me is that there are now moving forward, there'll be no difference between Section 1A and full FRS 102 relating to related party disclosures. As it stands, those using Section 1A have this arm's length exemption. So if a related party transaction currently happens at arm's length, you don't need to disclose it. Well, that's changing. So all the related party disclosures required by full FRS 102 will now be required to be made for those using Section 1A as well. Next difference, next change, looking at concepts and pervasive principles. More of a technical element here, but for example, they're changing the definition of materiality. May have little or no impact. Next one, if you hold assets at fair value, the definition of attribute or measurement of fair value is changing. It seems like a really subtle difference, but this will be for if you are obtaining valuations is something to consider. Is that they're moving. It will now be that the price charged to transfer a liability rather than the price to pay something. It's hard to even give an example of that, but the wording has changed in that area. Next one, looking at financial statement presentation. This will now require for all FRS 102 accounts that there is an explicit statement that this entity is a going concern. For those entities who are required to prepare a cash flow statement, there is now extra disclosure there that will need to be made for supplier finance arrangements. So interestingly, and I don't know why, but this is actually effective a year earlier than all of the other requirements. So this is effective from the 1st of January, periods beginning on or after the 1st of January 2025. So you're preparing your, if you have December 25 year end or onwards, this will be required to be in there. So please ask us for advice on that. Another fairly significant change relates to the notes to the financial statements. Now, we now need to disclose within the notes policies related to material rather than just significant areas. So the thought here is we'll actually end up potentially with less policies being disclosed in the financial statements, but there's a push to make sure that these policy disclosures are more bespoke, give more detail, rather than standard boilerplate disclosures. But like I say, it's thought because they have to be material to the financial statements, not just significant, that there'll be less of them. There's some changes relating to business combinations, so acquisitions, mergers. Some changes relating to identifying the acquirer and types of considerations, so variable consideration or etc. Some changes coming in related to share-based payments. There's details relating to the settlement of equity settled share-based payments and the measurement of cash-based payment transactions. There's also some further guidance given relating to uncertainty of income tax treatments. So if there's a circumstance at the moment, I think IFRS 102 is fairly silent on this at the moment until the revision and the extra guidance comes in. If there's a certain tax treatment that's being used and it's uncertain whether that will actually come to fruition, about how to account for that. It's based on probabilities of it being okay. So as an overall conclusion, the changes relating to revenue recognition and lease accounting really may be significant for you, depending on the number of leases, the type of leases, the type of contracts, how you contract your sales to your customers. You really need to be considering that at this point. The other changes can't be ignored either. Often in other webinars we've attended or guidance coming through from the ICAW, they're often pushed to one side, but they can have a significant impact. Especially, again, I'll reiterate that point of the related party disclosures being enhanced for small entities. So if you do need further support, please contact us. Refer to your Duncan & Top place or just make contact with our inquiries, and we'll be very happy to help and support you. So moving on to questions, we do have time. We have 8 minutes. So I just open the Q&A. So we've got 2 questions. One does ask if we share the slides. Now, unfortunately, we don't share the slides for the webinar. However, I was discussing this with Will earlier. We do have some guidance that we have released. I think it's on the same page as booking the webinar, but we can certainly, if you ask your contact to share that, we do have some guidance provided. What we also will do is extract our examples out of the slides, and we can share the examples, which hopefully will be a help to you. So Colton, thank you for your question. How do the lease changes impact lessors? Not that significantly. I think there are very few changes. Sorry, Will, I just jumped in on your section there. Are you aware of any significant changes for lessors?
Hi, Stuart. No, I wasn't aware of any. I think ultimately the lessors are going to continue to recognise their assets that they are leasing out in the same way and recognise their income in the same way, as far as I'm aware. It would only be if they were, of course, a lessee as well as a lessor, in which case they'd need to consider these changes as a lessee. But no, I think as far as lessors go, I've not seen any significant changes to the way they account for things.
Thank you, Will. Peter, thank you for your question. I think I'll just caveat this with saying myself and Will are not tax experts, but we have had the question you raised here asking what the corporation tax consequences of the lease accounting changes are. Now, I believe we looked into this following an internal queries, had this looked at by the tax team, and I believe the changes are tax neutral. So I don't think there will be an impact relating to the accounting changes. Will, is that your understanding also?
I believe that was my understanding of the discussions we had with James post the previous internal webinar. So yeah, my understanding is it doesn't affect tax charges, but I don't feel comfortable kind of advising how it would appear in a tax comp.
Thank you. Chris, hello, hope you're well. Chris has asked an interesting question. We did actually have this internally as well, and it's something we're currently researching. But will the changes to revenue impact recognition of farmers' income in terms of SFI income here? He notes that it's currently recognised on a receipts basis. We're waiting on further industry guidance or ICAEW guidance on this. I haven't seen anything that clarifies that point yet. It's a very good question. We certainly need to get clarification over that. But at this point, we don't have an answer. I don't believe. Will, I'll also clarify with yourself if.
Yeah, I say again, I've not seen anything that you haven't. I think we're still waiting for further guidance to come out on that.
Okay, thank you. Just having a look. No further questions at the moment. If anyone's got any further questions, like I said previously, please feel free to contact your your Duncan and Saltfleet's contact. Come through our inquiry lines. Ring up and ask for us personally if you prefer. And yes, thank you. Thank you for joining us this morning. No further questions, so I think we can close the webinar there. Thank you. There's one come in. Just so that it was a couple actually. Thank you, Tia. Will, would you like to have a look at William's query?
Yeah. So, in terms of the first part of your question, William, the guidance says that ideally you'd want the incremental rate. That is more accurate, more representative. However, there is an understanding that it wouldn't always be practical or necessarily possible to obtain that, which is why the obtainable rate is acceptable. I suppose in terms of the rate offered by the bank for the overdraft facility, if that is the best example of a representative rate that you can find, then I think yes. I think provided that is the most reliable parameter that you can find, then I would say yes, that is potentially acceptable. In terms of the rates used in the NPV model being subject to change, that's not actually an area that I've seen much sort of specific guidance on, but I would say that if we believe that they are going to materially change, then I think, yes, in order to give a true and fair view, we should always make sure that we're maintaining the most accurate and reliable rate at the given time within reason. Would you agree on that, Stuart?
Yeah, it seems reasonable, Will. Thank you. It's time for Paul's question here. I'll read it out in full. In terms of discounts and also allocating it to the individual accounts, what happens when we offer a rebate to the parent company when revenue targets have been met by the individual sites? Do we need to associate the rebates to the individual sites? I think there's quite a few elements here. And I think what I would do is want to see the specifics of the contract, how this is set up, whether the individual sites or individual entities, who the customer has a contract with. I think it will need further review to give a definite answer on that. But thank you for your question, Paul. And please feel free to send that across. We can have a look at that in more detail. I think the slide was more referring earlier in terms of you have the obligations and it's about splitting that overall cost of the contract between the obligations. So if one obligation perhaps was related to one entity and another, if there's like a multiple entities involved in the contract, then that revenue of the discount would be applied on a reasonable basis. I don't think there's a definite, it has to be applied on a straight line basis. So if you had three amounts, for example, applying 20%, because that's 20% of the overall revenue, for example, onwards, but on some sort of reasonable basis in terms of splitting that discount. Thank you. And we have come to the end of our time now. So again, thank you very much for joining us this morning, and please let us know if we can help further. Thank you.